Carnage is still underway in financial markets, and investors are rushing for the exits and repositioning while they still can because another painful stock market crash is on the horizon. In recent weeks, a massive sell-off accelerated after corporate earnings projections dropped below expectations, but things have gotten significantly more turbulent last Wednesday when the Federal Reserve delivered the third consecutive 75 basis points hike and signaled a steeper path of interest rate increases over the coming months. Against this backdrop, the S&P 500 and Nasdaq 100 suffered heavy losses, and the Dow Jones entered the bear market territory, falling 20% from its peak. In a few days, we might see a lot more chaos sweeping through Wall Street. Experts and strategists are telling us that those who believe the market will still bounce back are simply delusional, and they're about to get a reality check. Some of the brightest minds in the financial world are saying we should all brace for a major shock, one that will not only affect stocks, but businesses, households, crypto markets, and the entire global economy. That's what we're going to expose today. But before moving on, please support our work with a thumbs up in this video and subscribe to our channel to keep up with the most important news. In its September FOMC meeting, the Federal Reserve explicitly said that Americans should get ready for a deep housing correction, higher unemployment, and an economic recession as it continues to raise rates to control inflation. At this point, the entire global economy is set to face what could be the worst growth shock since the financial crisis. But despite the clear warnings, some market players are still delusional about how the stock market will perform in the rest of the year and in 2023. In August alone, the S&P 500 plunged by 11%, and the Dow fell 9%. Despite the losses, estimates for how much profit S&P 500 companies will earn next year seem completely out of touch with our economic reality. Wall Street's rosy projections for corporate profits do not consider the fact that even the nation's biggest companies are struggling with slower business activity and declining consumer spending. Inflation is still wreaking havoc on the economy, and the worsening profit outlook means that the people who are blindly optimistic are about to get burned. According to Bloomberg, Wall Street bullish analysts predict that S&P 500 companies' earnings per share will reach $229 in 2023. That's to say, even though the Fed promised to keep jacking up interest rates and threatened to induce a recession, some investors expect stocks to soar another 20%. But according to Justin Simon, the portfolio manager at the hedge fund Jasper Capital, these players are about to get bitterly disappointed. Simon says that even if corporate profits don't collapse too hard but just sink back down to the 2019 healthy level, it's still a long way down from where the stock market sits right now. The risk to the market right now is that earnings per share normalize to pre-COVID levels, Simon said, roughly $160 a share. In other words, if profits were to fall back in line with earnings, we would see another stock market crash of at least 40%, according to the expert. At the same time, while interest rates continue to go up, numerous companies that depended on cheap debt or lots of liquidity to survive will experience a brutal awakening. And that means profits, a critical part of how a company's stock is valued, are set to face a massive collapse. Earlier this month, big names such as Amazon, Walmart, Target, and even Ford have all lowered their earnings estimates, mentioning persistent supply chain challenges and higher operational costs. A couple of weeks ago, FedEx reported dismal earnings and lowered its guidance for next year based on the slowing global economy. The company's stock fell 24% after its announcement, as reported by Business Insider. Soon enough, when investors realize that there's a flood of companies in financial distress, we're going to see a devastating chain reaction. The carnage that's sparking chaos on Wall Street is likely to spill over into other sectors of the financial industry and even impact the finances of America's shrinking middle class. That's what the chief strategist at BubbaTrading.com, Todd Bubba Horvitz, highlighted in a new interview. He noted that the latest stock market sell-off helped to fuel the meltdown of the crypto market, which has lost $240 billion so far. Right now, crypto fear and greed index continues to slide lower, edging toward extreme fear. And Horvitz explains that higher rates will not only continue to crush stocks, but destroy, quote, what's left of the U.S. middle class. Powell is trying to get away from what's going to happen, which is going to be hyperinflation, Horvitz said. Wait until the price of oil starts skyrocketing again. What do you think's going to happen to inflation then? We're going to have a food shortage this year. We're going to have food riots in many countries, the strategist added. Overall, I expect to see a 50 to 60% crash in these equities markets, Horvitz said. If anybody looks at their own finances, they can certainly see that it's recessionary times and they're watching their spending. On the same note, Nouriel Roubini, who foresaw the 2008 financial catastrophe, recently came forward to alert that deteriorating economic conditions all across the globe will make the S&P 500 experience a significant correction by the end of 2022, bringing a lot of pain for market players, indebted companies, and U.S. households. Roubini, the chairman and CEO of Roubini Macro Associates, says that the S&P 500 can fall by at least 30% in any recession, but the coming crash is probably going to be far steeper as we witness a truly hard landing, he says. The strategist who acquired the moniker Dr. Doom for foreseeing the housing bubble fall in 2007 and 2008 says that the ongoing recession could be long and ugly, and he predicts that many zombie institutions, zombie households, corporates, banks, shadow banks, and zombie countries will perish as interest rates soar and debt servicing expenses shoot up. So let's check to see who's swimming naked, he said. The worrying outlook is leading an increasing number of market juggernauts to turn bearish on stocks for the months ahead. In the past few days, a number of them, including Ray Dalio, Jeremy Grantham, Carl Icahn, and Scott Minerd, have all warned that further downside is inevitable. According to a new expose published by Insider, the founder of the largest hedge fund in the world, Ray Dalio, sounded the alarm about a two-front battle that stocks are about to face. The first one is the higher yields they'll continue to see due to higher interest rates. Elevated yields in risk-free assets like treasury bonds makes riskier assets like stocks less attractive, he explained. The second blow comes from the economic damage caused by declining corporate earnings, which he believes are going to fall even deeper. I do believe that as you raise the interest rate to what's appropriate, that competitiveness is going to drive it down. And then also, it'll hurt earnings. It'll hurt the economy, the Bridgewater Associates founder said. Meanwhile, speaking at the Reuters Global Markets Forum on September the 7th, legendary investor Jeremy Grantham didn't sugarcoat the current situation of the global economy as central banks around the world tighten policy to contain the price spiral. This is a more dangerous-looking moment in global economics than even the madness of the housing bubble of 2007, he said, adding that the S&P 500 could see more than half of its value being wiped out, given that valuations were 2.5 standard deviations outside their norm. Grantham stressed that stocks were in their fourth super bubble in a century, and that every historical parallel suggests that the worst is yet to come. That's also what Carl Icahn said at the Market Watch Best New Ideas in Money Festival last week. I think it's gonna be worse before it gets better. The worst is yet to come, he added, pointing out that we're in a bad economic and financial environment, and at this point we can't escape from a reckoning day. Furthermore, Scott Minerd has mentioned that despite the latest corrections, stock valuations are still too high. On September the 8th, he shared a forecast that stocks by historical standards would fall another 20% by mid-October. Since then, stocks are down 12.2%. Minerd also advised investors not to buy stocks until the Fed has finished raising rates. People that are talking about a stock market bottom, I would just point out one thing. We have never had a bottom in the market while the Fed is still raising rates, Minerd stressed. Eventually, this will all end in tears. The truth is that no one really knows how much higher rates will go, or for how long the Fed will continue to hike them to be able to control inflation. But as the senior correspondent at Insider Lynette Lopez noted, whether that results in a short downturn or a recession, we know that whatever is coming won't be positive for corporate earnings. Since 1960, earnings have dropped during recessions by an average of 31%. And the longer the economic slump, and by extension the profit slump, lasts, the worse it will be for stocks. Well, in other words, all of the images we've seen of a screaming red stock market and sweaty traders doing the sign of the cross reflect the beginning of the end. Wall Street has been flying so high, it forgot that stocks don't always go up. And as Lopez outlined, the higher you fly, the farther you fall. You know, the law of gravity never fails to catch us up. Thank you for watching. We look forward to your comments below this video, and don't forget to subscribe to this channel.